You spend $25,000 renovating your home. You run your business from 200 square feet of a 1,600 square foot house. That means 12.5% of your home is your office, and 12.5% of that renovation, $3,125, may be legitimately deductible. But unlike a simple business expense, home renovation deductions involve depreciation schedules, the home office calculation method, and a recapture tax when you sell that most homeowners never see coming. Get this right and it is a clean deduction. Get it wrong and it creates a liability that follows you for years. The foundation of any home renovation deduction is a qualifying home office under IRC Section 280A. The space must be used regularly and exclusively for business, not a spare room with a desk that doubles as a guest room, not a kitchen table where you occasionally work. The IRS applies this test strictly. The space must be your principal place of business or a place where you regularly meet clients. Once a qualifying home office is established, the business percentage of your home, calculated as office square footage divided by total home square footage, determines what portion of home expenses are deductible. There are two home office deduction methods: the simplified method and the regular method. The simplified method allows $5 per square foot up to 300 square feet, a maximum deduction of $1,500, and does not involve depreciation. If you use the simplified method, home renovation costs are not separately deductible through the home office. The regular method requires calculating the actual percentage of home costs attributable to the office. Only under the regular method can renovation costs flow through as a deductible business expense. Your choice of method for a given year determines whether the renovation deduction exists at all. Renovation costs fall into two categories: repairs and improvements. Repairs are expenses that maintain the existing condition of the property: painting, fixing a broken window, replacing a faulty outlet. These are currently deductible in the year paid, at the business percentage. If your office is 12.5% of the home and you spend $4,000 on exterior painting, $500 is deductible this year. Capital improvements, a new roof, an addition, upgraded HVAC, extend the useful life of the property and must be depreciated over 39 years as non-residential property at the business percentage. The depreciation calculation on a home improvement works as follows: a $25,000 roof replacement on a home where 12.5% is office space. The depreciable basis is $3,125, 12.5% of $25,000. Divided over 39 years, the annual depreciation deduction is approximately $80 per year. That is not a compelling deduction on its own, but it accumulates. A $50,000 kitchen renovation, $60,000 HVAC system replacement, and $25,000 roof over 5 years of business use creates a meaningful depreciation base, all tracked through Form 4562 and reported on Schedule C or Form 8829. Renovations exclusively to the office space itself are treated differently. If you recarpet only the home office room at a cost of $3,000, the entire $3,000 is a business expense, not just the 12.5% portion, because the renovation is 100% business. If the improvement is to a shared area, the business percentage applies. If it is exclusively to the office, the full cost is deductible, either currently or depreciated depending on whether it is a repair or an improvement under the IRS's tangible property regulations, which provide specific safe harbors for amounts under $2,500 per invoice. The depreciation recapture issue is where most homeowners are blindsided. When you sell your home, the Section 121 exclusion allows you to exclude up to $250,000 of gain from federal tax, $500,000 if married filing jointly. However, any depreciation you claimed on the home office portion is not excluded. It is recaptured at a maximum rate of 25%, regardless of your regular capital gains rate. Even depreciation you were entitled to but failed to claim is still considered as if it had been taken, under the IRS's allowed or allowable rule. Failing to depreciate does not protect you from recapture. The allowed or allowable rule is worth pausing on. If you used a home office for 6 years, took the regular method, but forgot to claim depreciation on 3 years of improvements, the IRS treats those 3 years of depreciation as having been claimed when it calculates your recapture liability at sale. You missed the deduction, but you still owe the recapture tax. The solution is consistent record keeping from the moment a renovation is completed. Document the date, cost, business percentage, and classification of every improvement on a running schedule that you update annually. 2 practical safeguards. First, if you intend to sell your home within the next 3 to 5 years, consider whether the long-term depreciation deduction justifies the guaranteed recapture liability. On small improvements, the maths often favors simplicity. Second, if you convert the home office space back to personal use before selling, genuinely, not on paper, the recapture liability does not disappear, but it can affect the calculation of which portion of gain is subject to recapture versus exclusion. Get tax advice before converting the space or listing the property if home office depreciation has been claimed. Home renovation deductions for home office users are legitimate, meaningful, and frequently missed, but they carry obligations that extend beyond the tax year in which the renovation occurs. Keep records of every improvement, track your depreciation annually on Form 8829, and understand the recapture rules before you sell. Done correctly, this deduction reduces your tax liability steadily over many years of business ownership. If you want to understand how home office costs and other mixed-use expenses interact with your business structure, our video on why mixing personal and business money destroys your deductions covers the exact rules.